Dividend investing in Singapore can bring in yields of over 4%. But how do you pick a dividend stock that will really pay off? It's not just about today's yield, it's about the growth in yield in the future.
Number one is the revenue, so it has to be growing over the years. If I'm looking at a 10 years track record of the company, on average, has it been able to grow between 5 to 10% per year in terms of their revenues? Same goes for their net profits, because this then tells me that the company is able to take the profits out from the company to pay dividends to its shareholders. It's also important to look at how diversified these revenue sources are. One risk is looking at companies where they might only have a concentration of just one customer, which accounts for maybe at least half of their revenues. And this can be dangerous because if the customer suddenly pulls out, that could be a big impact to the revenue of the company.
Dividends are paid from cash, not just profits. A company with strong and consistent free cash flow is better positioned to sustain its dividends. So how do you spot such companies?
In this statement, the company earns about 72 million, and after adding back all the non-cash flow items and plus the working capital, which include inventory, receivable, it has an operating cash flows of 86 million. So from 72 to 86, actually they are generating more cash than what is shown as in the earnings. Yeah. Then from there you will have to see what kind of acquisition or purchases of equipment they made. They could have used this money to buy property, plant and equipment. So you need to less it off. So after lessening off, for example, it's about 8 million. So 86 minus 8 million, you have 78 million. So it's very healthy. This company is able to generate a free cash flow of 78 million. That will mean that if you invest in this kind of company with good free cash flows, you'll be rest assured that, as long as with the management commitment, you will receive the dividend payout. Yeah. So you want to have sustainable dividends. So companies like that, they will be able to pay. So you want to avoid a company whereby the earnings is good, but then net operating cash flow is negative, or either that is positive, but after lessening off the capex is negative. So that literally they have no money to pay you.
Dividend investors favor mature companies with stable revenue, profits, and cash flow, and those that build habit-forming products and services.
So you're looking at daily essentials, grocery products for instance, food, electronic products, your detergents, your kitchen equipments, and this forms a very strong habit around the customers. It also allows companies to raise the prices without having to put in more capital to improve the product or conduct R&D, because the product already sells by itself. So it's a form of habit for the customers, and you can continue to raise prices this way. And with the increase in prices, it's able to take the excess profits to pay and grow the dividends for their shareholders.
One common rookie mistake is to focus solely on the dividend yield.
A high dividend yield sometimes can be a potential trap. And one way to actually look at a dividend stock, other than just the dividend yield, is to look at whether there's a sustainable form of dividends. So sustainable form of dividends, I look at what I call the dividend payout ratio.
The dividend payout ratio measures the portion of a company's earnings paid out as dividends.
Typically, I want to have a dividend payout ratio between 20 to 60%. This means for every $100 a company makes in profits, it pays out between $20 to $60 of dividends. This tells me that the company has not only enough room for buffer in case their profits drop, but they can also meaningfully increase the dividends over time.
If a company has always paid out a very high payout ratios, more than what they made, that is a big concern, because it may not be sustainable. Because when you say you want to buy quality dividend stock, right, you want it to be sustainable. You don't only collect, this year. You also want to collect for the, as long as you're holding the portfolio. Yeah. So for company with a high payout ratio, it's likely that earning has dropped. So, but of course, you need to assess what has caused it to drop so much.
Another tip is to look beyond yield. It also pays to look at companies offering lower yields with strong growth potential.
So the dividend yield might potentially be lower than the risk-free rate, but over the years, it might actually grow over time. So it can actually increase the dividends. Say for instance, if you look at a stock called Parkway Life REIT, where they own hospitals in Singapore, which includes your Gleneagles hospitals, they lease out properties, they lease out space to hospital operators like Gleneagles hospitals, and every year they increase the rental rate according to the revenues which this hospital make, or they increase based on the CPI inflation rate. And this means that as the years go by, the rental income increases for Parkway Life REIT. This means that it's also able to grow its dividends. And this is important when we are looking at the dividend yield, because when you look at a stock's dividend yield, it should be growing over time, even though it's a low dividend yield, but it should actually grow year after year.
Should a new investor be put off by high valuations of in-demand dividend stocks? Willie says you should keep in mind their potential for reliable returns and capital appreciation.
For dividends, what you are typically looking out for is to compound two things. Number one, you want to grow the dividends over time. Number two, you also want to meaningfully grow the capital. You also want to meaningfully see a capital appreciation on the share price of the stock which you invest in. So when you look at dividend income, the dividend income allows you to generate the passive income for yourself. The capital gains allows you to cover the cost of the capital which you invest in. So the share price alone doesn't determine how expensive or cheap it is. A stock where might be trading at, let's say, $200 per share. It could be cheap based on the dividend yield. A stock which trades at, let's say, $20 might be expensive because the dividend yield is very low. So it depends on the dividend yield which we are looking, the historical dividend yield which we are looking at the stock itself. So you want to buy it when it's cheapest, so-called cheapest, which is at its historical high dividend yield, and be more careful when it's trading at a historical low dividend yield.